If you've ever read the Winner's Curse book, that is very true in our business. If everybody loves the deal, there's no hair on it, nothing that needs to be fixed, you're going to overpay, and your returns are probably going to be a lot less. I'd rather buy a business that you understand what the risks are, where there is a lot more upside on that opportunity.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here with Adam Penn. Hello, Adam.
Hey, Dustin.
How are you today?
I'm doing great. It's like 70 degrees. I'm supposed to get up to 80 this week.
You're talking about the weather.
I like the weather. It's sunny out.
Well, that's nice. It's we're getting some of the final. We're recording this here in late April, and it's late April's in the Midwest, I guess, in the Southeast and the plains and all that is severe weather time. So we're getting.
I think I was talking about the weather because I have a house without a roof on it right now. So every time it rains, I get water inside of our construction site, which is not great.
You should really put a roof on that house. You know, it's a problem.
It's on the to-do list. I was going to paint the inside. Then I figured we'd roof it afterwards.
I just see that like there's a line item like put roof on house. Check.
Mm-hmm.
Yeah, you don't want to forget about that one. Make sure it gets on the list.
We have roof house, finish house. Those are the two items on the list.
I mean, that's basically all you need to know about real estate, right?
Like you flip a house.
Yeah.
Start project, finish project. Done.
Exactly.
Yeah.
Oh man. Well, we have a guest today. We have Sequoya Borgman, who is the founder and CEO of Borgman Capital. They're a private equity firm based in Milwaukee, and pretty interesting. So I don't think we've had any guests on so far that are in the private equity space, like true, like buying businesses, private equity space. But they focus on the lower middle market businesses. He had a career in public accounting, was actually at Arthur Andersen when all the stuff went down with Enron. And then interestingly enough, our times like at Deloitte, we were at Deloitte at the same time.
You guys
for at least a few months, I think. What's that?
Your cubicles were next to each other?
Our cubicles were not next to each other. No, we were in separate offices, and I think he was either a senior manager or a partner by that time, and I was still a lowly consultant at the bottom of the totem pole. But yeah, excited to talk about him. I think one of the things that's interesting here, and why I was excited to have him on, is they actually have a fun. It's not a fund, but it's a vehicle, a way of bringing these businesses to retail investors, which is typically when you think of like business private equity, a lot of times it's been a very institutional space, very large check sizes. So excited to have him on and talk about the way that individual accredited investors can get some access to this space. But with that, we'll dive right in.
Sequoia, happy to have you on the show today. Love to hear a little bit more about your background and kind of what you work on a day-to-day basis. But do you want to start by telling our audience just a little bit about yourself?
Sure. Thanks for having me on the show. Happy to tell you a little bit about myself. I started out in public accounting about 3 decades ago. I started out at Arthur Andersen out of college after getting my master's in accounting. And spent 18 years in public accounting after Andersen went down, went to a couple of other big firms. It looked like we overlapped at Deloitte a little bit, Dustin. But it was a great training, great experience. That's where I really got introduced to the transaction M&A space, and ultimately really got to work with some great private equity firms around the country and work on some of their transactions and help structure them. And really got the bug, got the itch to do it myself. So almost a decade ago, I decided to jump on the other side of the table and launched a firm, and really haven't looked back. I wish I'd done it earlier in my career, but it's been a great run. The last decade or so, we've bought 20 plus companies and really grown a really nice practice here throughout the country, and excited to be doing what we do.
That's awesome. On the merger and acquisition side of things, this isn't a space that everyone hears about all the time or really is in themselves. So can you walk us through what some of those transactions might look like, or what your typical deal looks like?
Yeah, I mean, there's thousands and thousands of different groups doing kind of similar stuff in the space, but really what we're focused on is lower end of the middle market. We're kind of value investors investing in really just family or founder-led businesses that have been around decades, have an established business model, maybe second or third generation in the business is not interested in running that business, and the owners are looking for a succession plan. So we'll be part of that succession plan. We'll come in, we'll invest in the business either through a total buying all the equity or buying a large majority of the equity, and then we'll help them transition to kind of a professionally managed business as the owner transitions out over a period of time. We'll bring in a new president, maybe a new CFO, and depending on the management team, maybe add to the resources there as well.
So that is definitely helpful for the people trying to transition out of it, but you also obviously have to bring capital to the table. Can you talk through a little bit of how you structure the actual acquisition from the capital stack side of it?
Yeah, when I first got into the investment side of the business, that was the part that was I didn't come from another private equity firm or investment bank where I was used to raising capital. So when I started, I really went around to my friends and network, and we put together a pool of capital for the first acquisition, and that went really well. We had 26 investors in that original deal almost 10 years ago, and really nice exit, nice investment. And over the years, our investment network has really grown up very similar. A lot of family offices, a lot of ultra high net worth individuals, and really just a lot of accredited investors. So anyone that's a credit investor, when we buy a company, we set it up as a special purpose vehicle. It's a Reg D filing. Anyone that's accredited, we have a third party that verifies their accreditation, and they're able to participate in that investment offering. And as our investor group grew, and it really grew by our investors would tell their friends or other family offices, and they would invest with us on the next deal. And before long, we had hundreds of investors that had grown in our investor group. So maybe 3 years ago, we invested in launching an online investment platform called Pass the Hat, and that's fully targeted for kind of accredited investors that want access to kind of direct lower middle market leverage buyouts, really our bread and butter. And that's grown, and now we have over 500 investors that have invested with us. The Pass the Hat platform, really it helps with the onboarding. It kind of automates the whole process. It helps with the third party accreditation process, and it also helps with all the administrative part of the business, all the investor relations, all the fund administration, all the tax reporting, all the quarterly and annual reporting that the investors require, and really all of the communications that we have with the investors. So that's been a very successful launch, and really one of our biggest complaints at this point is we don't have more investments to put on that platform. But that's really a good problem to have.
Yeah, when you started, you needed more investors. Now you need more investments. It's funny how the things kind of shift over a period of time.
It does. At the beginning, I never knew how I was going to raise that money, and now that's the least of the issues. It's finding good investment opportunities is really the challenge. It was a lot easier in the 2010s to be doing deals. It's kind of slowed down here over the last couple of years with what's been going on in the economy and interest rates and really the competition. There's a lot of money that's going after these same great investment opportunities. So the tide's definitely turned in the last several years.
Do you think that just makes it harder to find deals, or does it actually dilute the quality of the deals that you're able to buy?
Well, since we don't have a committed pool of capital, we have no pressure to do deals just for deals' sake. I think there is some of that pressure. You'll see some of the larger funds, their returns have been coming down as they've been moving down market or paying more or all the things, or putting less leverage on business. All of that impacts your IRR. So there is some of that. But with our model, I mean, if we're investing personally in these deals, we look at them. If we don't feel like we're going to get a great personal investment, we don't go after them. We have really no pressure from a fund or LP base that requires us do deals for deal's sake. So we look about 1,200 deals a year to do 1, 2, maybe 3 deals, 4 deals in a good year. So we're not one of those shops that are just very active. So that's one of the nice things with our model.
Can you tell me a little bit about, you don't have to give away all your secret sauce, but you take over these businesses, right? You're there, like you said, you're buying all the equity or majority of the equity and helping these business owners transition out of it. What does that look like? I mean, you're putting in your own systems, your people. What kind of core functions are you able to replace with more of a professional management side of things?
Yeah, that's the biggest risk in investing in these part of the market is a lot of the business knowledge and institutional knowledge is in the head of that leader, and it's really hard to bring in a new person to replace them. Usually we have to hire 3 or 4 people to replace the one owner, and then invest in ERP systems and all kinds of infrastructure and processes that a professional business would require. But that's why we're investing at the multiples that we're investing in, because a lot of the larger investors just don't want to go through that heavy lifting. So we're able to get them at really, really good multiples that's fair to the business owner, but also fair to our investors. And we do have to put in that extra time and effort and maybe a little bit of extra capital in order to professionalize that business and take out that transition risk.
You've been doing this for a long time, and as you said, you've seen a lot of deals, and you've said no to a lot of deals. What's a deal that you just absolutely would never buy that type of business? Is there a specific industry that you totally lean away from?
Well, anything that's really competitive that's driving the multiples up, we tend to stay away from. So the stuff that if we see a deal and we love it, it means everybody loves it. So you're going to overpay for that. If you've ever read the Winner's Curse book, that is very true in our business. If everybody loves the deal, there's no hair on it, nothing that needs to be fixed, you're going to overpay, and your returns are probably going to be a lot less. I'd rather buy a business that you understand what the risks are, going in what you need to fix, and you're getting it at a fair multiple where there is a lot more upside on that opportunity. So those are the businesses we go after. But the spaces that are just really, really competitive, we tend to pass on those. And then, there's a lot of risk that we'll stay away from as anybody. I mean, too much concentration and those types of risks. Those deals are very difficult to get done, but it's not really an industry specific. It's more kind of what are the risks in that particular business.
Do you stay focused in a certain area, or are you happy investing in a wider area?
I like industrials. I like food stuff that has very steady cash flows. I mean, it's the leverage buyout model. So the businesses pay down the leverage, pay down the debt. So you need something with steady cash flow. But we've been very creative. We've been invested in multiple industries. We've invested all over the country. So we'll look at something and dig in, especially if we're working with kind of an operator or somebody that really has been successful in that space. We put together a professional board of industry insiders that can add a lot of value, and we will look at stuff that maybe we hadn't invested in the past. And if we can kind of understand what levers will meet the investment requirements that we have, we'll pursue it.
Awesome. Dustin, don't let me take all the time here. What questions do you have?
Yeah, I guess a few things here. I've been jotting down some notes. Sequoia, I guess first on, you mentioned multiples, right? And that's typically, you're valuing a business on some sort of multiple, I would assume EBITDA or modified EBITDA, something like that. But I'm curious, like, how you approach valuing the businesses, and then what multiples do you like to see?
Well, the lower the multiple on the entry, usually the higher the return. So
Sure.
It does have a big impact on what you pay. I know on some of the larger deals out there's been some studies that say the value creation has a bigger impact on the ultimate return, or cash on cash return, or IRR. But I think in the lower middle market, on the businesses that we're investing in, buying right, using some structure like seller notes or earnouts or some type of contingent financing, all of that really has a huge impact on what your ultimate return is for your investors. So we really focus on that. The better the multiple or the better terms really help us boost the ultimate exit multiple. So yeah, I mean, but we track all the. I mean, GF data is a good source of data in for lower middle market deals, leveraged buyout deals, and those are deals under 250 million. Most of our deals are under 50 million, so I'd say we're even on the lower end of those. And the trends have come down a little bit, but they're still about 7.2 times for these types of businesses that we're going after. Some high growth businesses go for higher multiples than that, or double digits, and there's some roll up areas that are very competitive. They're going for double digits, but most of the businesses we're invested in are more kind of the 4 to 8 time. Usually EBITDA, but sometimes we look at cash flow if it's a real capital intensive business, but you're really paying a multiple of that cash flow. And that's what impacts your return the most.
Sure. Talking about the capital stack, that's another thing I'm kind of curious about. You mentioned some seller notes, some earnouts, things like that. Like, do you have a typical structure that you like, or is every deal unique? I'm just kind of curious if you could talk a little bit more to what, because it's obviously not all cash, right? And there is a loan, and there's probably multiple loans. I'm just, for people who've never had exposure to this sort of space before, these deals look different than like a real estate deal where you've got the equity and the bank note, right? Like, can you kind of go into what that typically looks like?
Yeah, I mean, traditional leverage buyout, which has been around forever. I mean, you're buying a portion of that business with debt, which is much lower than the equity expectations. So, say you buy a business with half equity and half debt, the business pays down that debt over, say, 5 years. You've doubled your equity value in that business with really doing nothing, not growing that business. So that's 2 times your money in 5 years. That's not a bad investment. But if you're able to create value, increase EBITDA, increase margins, grow revenue, pull some of the other value creation levers, you can really get a really nice return in a leveraged buyout. But it's because of that debt that you use to acquire that business. That's also the risk. If you put too much debt, say you buy it with 70% debt and 30% equity, and that business isn't generating enough cash to service that debt, that's where you have the risk in this business. And that's why you're getting the bigger return. So it's always a balance. How much debt can you put on the business without overburdening it with risk? So our typical structure, we usually put maybe 2 to 3 times senior leverage, which is traditionally from a kind of a senior lender, a bank. And then we'll put maybe a turn or so, a one-time cash flow again, of maybe subordinated debt, mezzanine debt, and that's usually maybe interest only, non-amortizing debt, or that could be the seller note. I mean, that's the best financing, is through the seller. They know the business the best, and if they'll take some of their proceeds over a longer period of time and get a nice interest payment over a 5 or 10 year period, that really helps with the with our returns and also with the debt structure. And then above that is usually all equity. So it's some combination of debt and equity, but I'd say 2 to 3 times senior leverage, which is your lowest rate, and then some subordinated debt, mezzanine debt, or seller note, and then equity. And sometimes on top of that, if it's a real growth business and there's some upside that the previous owner wants to capitalize on, there'll be an earn-out or some type of structure where they get some more equity or funds if the business hits certain hurdles.
Sure. Okay. I'm curious sorry, Adam, I don't know if you're about to ask a question. Okay. On the exits, what does that look like? What's your time frame on that? Do you typically go into these looking to, essentially flip the business, or, add the value and then be able to sell at some point? Or is the idea to, effectively create a portfolio of these and hold them long-term for the cash flow?
Well, since it's not a fund structures usually have a 10-year life where you invest and you get your funds back in 10 years or somewhat. And usually they have a 2-year extension, so you get your funds back within 12 years. These are special purpose vehicles for each company, so there is no life. It could be an evergreen fund. Most of these businesses have been around, again, 50, 70, 100 years, and it takes a long time for those businesses to really generate a bunch of value. So we can hold them a long period of time, but truthfully, once you deleverage the business, unless it's growing at a much faster than kind of the industry or the economy, it's probably the best time is to sell around that period. That's when you'll get your best IRR. You may get a lower cash on cash return, but the other thing is all our deals that we purchase under $75 million, we structure as a Section 1202 qualified small business stock, which gives you a real good tax benefit if you hold for 5 years. And they've just changed that to a 3-year hold for some of the benefit, but still you have to hold 5 years. So we try and hold 5 years for our investment just to get that tax benefit. It really boosts your net after-tax returns. Sure. And that does come into our kind of timing on when to exit. But for us, I mean, we're incentivized to get the funds back to investors as soon as possible, just with our carry structure, and the management teams are all incentivized as well. So if we hold 10 years, the management teams or our firm doesn't get paid until that happens. So if we could sell in 5 years, that'd be a higher benefit for us, and that aligns with the investors' interest to get a higher return sooner as well.
Sure. So for, let's say, a retail investor evaluating this space, where would like this sort of private equity fit in their portfolio, so to speak? Is it more growth? Is it more of the cash flow play? Is it a little bit of both? Is it going to depend on the deal? I guess maybe this question is two questions. Like, how should someone think about where this sits in the portfolio, and then also what type of investor is this typically best suited for?
Yeah, it's a good question. I look at it as there's a whole range of alternatives, and they're kind of on the risk scale, and you go from kind of low risk real estate deals, and then there's riskier real estate deals, say development deals. So we're kind of below the risk that's like angel investors or venture investors, growth equity, below that stage, kind of more on the lower end if you're looking at kind of a real estate deal from a risk standpoint. But the returns are, I mean, we shoot for probably 20 to 30% IRRs in order to go forward with the business. So it's higher than real estate, but lower than kind of a venture deal. But venture deals, you're going to have a lot of misses in those deals. So, and we do some real estate investments. A lot of the businesses we buy have industrial property that come along with the business, or we talk to the business owner and they want to sell their buildings versus their business, vice versa. So we'll set those up as a separate investment opportunity for our investors sometimes as well.
Got it. Okay. Adam, I think that was most of the questions that I had. What else you got?
I think maybe the last question that I have is, you talk briefly about kind of the size of business you're buying. You're looking in that $50 million range, but is there no opportunity below that, or does it just not make sense to try to deploy capital on, let's just say I'm going to use an example of a roofing company with maybe making $2 million, $3 million a year?
No, we'll definitely look at those. Probably $3 million of cash flows, probably towards the lower end of what we'd look at. But those are great opportunities. A lot of consolidation and roll-up opportunity in that space. So, and those you're paying a much lower multiple. So if you could find a couple of those, that's a good return. So no, I mean I'd say we invest probably under 15 million of EBITDA as most of our businesses. Over that, it gets really competitive. And truthfully, these days it's competitive over $5 or $8 million of EBITDA. So we find some of the best opportunities probably in the $4 to $8 million cash flow space, a little bit less competitive, although these days it seems like everybody's coming down market, so has become pretty competitive. But we'll look at businesses with $2 or $3 million of EBITDA. It's just there's not enough real room for our investors to get in there. Like with the number of investors we have, we probably need to do something that requires $5 to $20 million of equity in order for our investors to have room in that opportunity. So that's one of the things that we have to take into consideration.
Sure. I have two more questions, I guess. We've talked a lot about the mechanics of private equity here, and I I could nerd out on this stuff. I enjoy it, but I am curious. You had the career in public accounting and made this step to transition, and you said, why didn't I do this sooner? What was that transition like? Like how was that tough? Was it something you'd been thinking about for a long time? You sort of wished you had been wanting to do it, and something kept holding you back. Like, what's that transition from going from that, the employee route to being more of the, doing your own thing?
Yeah, it was a big risk. I mean, I had been a partner for quite a while at that time, and partners at big firm have pretty good lives. I mean, I can't say it's not stressful, and you don't have client expectations and deadlines, but I just couldn't see myself doing that for the rest of my career. I had another 20 plus years on my career, and I wanted to do something more entrepreneurial, something for myself, and saw this opportunity and made the leap. It wasn't easy. Definitely, my wife was not had some stress over the whole thing, but it worked out. I mean, actually, the first deal I had fell apart, so that happens. That wasn't the best. The owner decided not to sell really about a week before close. But fortunately, I found another opportunity soon after that and started building out the team, and really that's what I'd say was the biggest factor in our success, is just having some good investment opportunities right off the bat. I know a lot of other people that have tried to do something similar and just weren't able to find something in that first couple of years, because if you don't have a great savings, you're not making any money while you're doing this until and truthfully, until you start selling businesses in private equity. People think you make a lot of money, but you don't make any money buying businesses. You're investing your time, effort, and you have to invest in every deal as well, just so you have skin in the game. So there's a lot of cash outflow for that startup period. But there's a lot of upside on it as well. But I feel like you learn something new every day. You meet with a business owner and hear their stories about how they created something really cool, and you see all the ups and downs that they went through that business cycle, and just walking through facilities, seeing how things are made. I mean, that's fun. I could do that every day. So I don't miss public accounting at all. I can tell you that.
That's awesome. Well, I guess our last question, we ask every guest this. So we're the Wealth Independence Podcast, and sort of those words, independence and freedom. It's a large part of what means a lot to both Adam and myself. And just always like to ask every guest, what do those words mean to you? How do you live that in your everyday life? Like, what do you think of when you think of freedom or independence?
I think a lot of what you're doing and what we're doing is what gives you that freedom and independence. I mean, when you have passive income, and they call it mailbox money, you can be laying on a beach and you're still getting paid. That gives you the opportunities to do what you really enjoy in life, and that's the definition of independence and freedom as well, is to make your own decisions, do what you enjoy, pursue your passions, and passive investments, alternative investments really allow you to have that flexibility, and I'm not saying it's not hard work, and there's a lot of risk that goes into it, but it is definitely worth it when you're successful in that space.
Sure, that's awesome. Adam, any? All right, you're muted there. I don't know if you were trying to talk or not. Okay, must be background noise in Adam's home studio. Well, Sequoia, we appreciate you joining. Thanks so much. This has been interesting. We haven't. I don't think we've had anybody on the show yet that's talked about this space. We've been a lot of real estate focused. And there's a lot of parallels here with real estate, but it's interesting to, like I said, I could nerd out on this for a while. So it's interesting to hear about sort of another way of investing, and also like the vehicle that you've got where retail investors can participate in this. Because I think more often than not, people think of private equity as being a more institutional space. So. I guess on that note, if folks want to connect with you or learn more about the fund, what's the best way for them to do that?
They can reach out through passthehat.com or reach out to me on LinkedIn. A lot of people do reach out to me on LinkedIn, or they can go to our website, borgmancapital.com, has my contact information on there. But yeah, love to talk to anybody that's interested in the space, or anybody that has a deal. We'd love to partner with people with the deal as well. So, sure. So reach out to us for either of those.
we'll make sure links to all of that make it in the show release notes. But
Great.
Good deal. Well, thanks again for joining us, Sequoia. We appreciate it.
Yeah, thanks for having me.
Yep.
Nice talking to you.
All right. Well, I enjoyed that. Like I said, I could have nerded out on the mechanics of buying businesses and all this stuff. Like I think I may have mentioned this after we pressed stop on the recording. But I've been interested in this space for a long time. It's something I feel like I could go down and start doing myself to sort of sit in his shoes. So this was definitely fascinating to me. I don't know, Adam. Was it what did you learn? What were your big takeaways?
Well, I think the PE space is cool, and I think I told you the other day we're looking at starting a PE fund in just our local area for businesses with the same problem, right? Founder level people want to retire, the kids don't want it, and they don't want to fire all their employees, and no one wants it, right? And especially in the space that we're looking at, it's even smaller, right? People might not be. We're thinking like $500,000 to $1 million a year cash flows. That's way lower than he'd be willing to bid on. But still $500,000 a year that these businesses make, or $1 million. Yeah. So interesting to see the way that he thinks about some of these things and the way that he looks at the different deals. One thing that kind of stood out to me is that, we're very cash flow focused, and his was very equity focused, right? All the cash flow was going down to pay off the debt that they maybe got when they bought the business. And then as soon as that was done, they wanted to sell. No problem with that. And like he was saying, he'd probably make some really high returns. He was talking in the high 20s and up to 30% IRR. But that means that you do not have these streams of cash flow to live on. You're just going from equity to equity to equity. So
it's definitely an equity growth business, which is not bad, but you as an investor, obviously you got to know that going into it, know what you're getting into. I think that the LBO model is interesting. Where you turn around and you do buy cash flowing businesses, but the whole point is to use the cash flow from the business to pay down the debt. And then there's a lot of parallels with real estate, right? Like you typically with real estate, obviously we're using the cash flow to pay the debt, although usually it's not designed to pay it totally all the way down. But then also the value add component, right? He talked about that, about how you want to go in and do something to increase the value of the business, whether that's increasing the earnings, increasing the margins, do whatever to be able to sell that at a higher value later. And I mean, that's no different than buying an apartment building and rehabbing units and pushing rents and things like that in order to get a higher a cash flow, and then you get the multiple of that, which is the value, right? Like it's very, very similar. I actually remember the first time, like maybe this is embarrassing to say, but as a finance major, I don't know, I was like 10 years out of school. Well, it wasn't that long, probably 7 years out of school before, you always heard leveraged buyout and stuff like that. And I mean, that wasn't something that was part of the curriculum, but at the same time, I don't know, maybe I should have known what that was. And it wasn't until I actually got into real estate and understood sort of this model that I was then able to apply it back. And I'm like, that's what an LBO is. Okay, I get it now. But there's a lot of parallels, right? And I think it makes, like, if you can sort of have these mental models as an investor for going for something, and then you can apply that to another space, it makes it a lot easier if you ever consider going into that. I'm interested. We need to do some research on the tax code. It was you wrote it down, right? Yeah. So I need to look that up, because that's kind of fascinating, because that was one of my thoughts initially, and I didn't mention this when we were recording, but I thought, well, if you're going from equity to equity, there's not depreciation, like there's not a lot of tax benefits on this, but it definitely sounds like there's some stuff in there that, just from where probably you and I are not familiar with the space, there's some benefits.
The stock holding side of it would be interesting, because if you're paying down all that debt, then you also have a lot of phantom income that you're not actually seeing, but it is income the business has. So yeah. And then I wonder too how this would play in like a retirement account, and from that standpoint, if it's just shares, then it probably functions no different than stock. Any other stock that you would buy. But I've definitely got a little list of things here that I'm personally going to do some research on. But I don't know. Any final comments, Adam? Not that I can think of. It was an interesting interview.
For sure. And like I said, we'll make sure that I'm looking here at the URL. It's passthehat.com. So if you are interested in this, go check that out. We'll make sure that and link to Sequoia's his LinkedIn, and then his main website. We'll make sure all that gets into the release notes so you can very easily access it. But if you enjoyed this, as always, we would appreciate doing all the things that lets those computers know that you're enjoying it. Give us a 5-star review on Apple Podcasts, like and subscribe on YouTube, and whatever it is you do on Spotify. We would definitely appreciate that and help us get the message out to more people. But as always, we appreciate you listening, and we will catch you on the next episode. Just remember, where freedom leads, where wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice, and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.